Name is John Casmon, and I am excited to have this conversation today. I am the founder of Casmon Capital Group and also the co-founder of the Midwest Real Estate Networking Summit. We're excited for this year's event. We've got that coming up May 6th and 7th in Chicago, and tickets are on sale right now. If you want to get your pre-sale tickets, they actually go up in price after tomorrow, so it's a great time to get it. But this conversation is going to be a great one. Obviously, the last week has been rocked in the financial world by the collapse of Silicon Valley Bank. And we're going to bring on Guaranteed Rates Sam Sharp to talk about how this could impact real estate investors. So without any further ado, let's welcome Sam Sharp.
Hello, hey
Hey,
John, how you
Sam.
doing?
I'm great, man. I'm great. How are you doing today?
I'm doing good. Nice to see you. Very excited for May 6th and 7th for the big event. Nice to see it back around and coming out full force.
Yeah, man. Been a couple years since we had a chance to do this live and in person. So excited to get back to that. We've had over 300 attendees the last time we did it, and you're going to be there and Guaranteed Rate, and not myself, my partner Bree Schmidt. We got Jay Papasan from The One Thing and a host of other speakers. So really excited about that. But Sam, today I really want to just talk about what's current, right? I mean, this Silicon Valley Bank situation has made a lot of people think twice about kind of their relationship with their lender, their relationship with their bank, the way they make their deposits, and really just the overall impact. I guess, for those folks who really don't understand exactly what happened, could you give us a quick high level recap, and then talk to us about, the impact it may have with real estate investors?
Yeah, happy to help. Yeah, interesting as we've seen this unfold. But to simplify it, basically, that so given the situation, the SVB followed a pattern that is traditional in the banking industry, right? They took in a large amount of assets. They have to take those assets and put them in a safe place. Treasuries have, banks have historically placed money into treasuries for a safe haven, which, if you don't have to become liquid in a very short period of time, can be a better bet. Now, I've heard a lot of people say, well, they didn't do anything wrong. They followed the playbook. And you could say that, although it could be argued that they didn't do anything wrong if they thought interest rates were never going to go up, and that some people might actually start to pull back. And that's realistically what happened, right? So they bought treasuries. A lot of attention got called towards where they were putting their money, how quickly they were growing. And then there's really one main investor who started spreading the word about there's a problem and you should get your money. It's like a run on the bank, right? And people ask for their money back. They're not liquid. They say, okay, how are we going to get the money back? We're invested in these long-term treasuries, which had this taken 3 years, when these were mature, then it wouldn't have been as much of a disaster. But now when you have to sell them short at a loss, how are you going to sell in the open market? How are you going to sell someone, something that's going to pay 1 to 2% when the going market rate pays 5? So it creates a big position, and then now all of a sudden everyone else is starting to panic, and that's human nature, right? So we start looking at the way that you start looking at a position where everyone's starting to question their banking practices, where their money's at, and their safety, and I get it, and rightfully so. With the reality being that had there not been a demand for that liquidity, there would not have been an issue, right? It wasn't a performance issue, kind of, without saying that. I don't want to get into the details because actually there was obviously some issues, but and there's a lot of other banks that have followed these same practices that will fall prey to the same situation. So we're going to see more of this coming up. Now, what going through and looking at this, when you're talking about how this impacts real estate investors, liquidity, right? When we're in a position where you've got two things that are going on right now. So banks take deposits and they lend money, right? That's the model. Give me your money. I'm going to give it to someone else and make money off it. I'm going to keep your money safe. If the first problem we run into that we started to recognize in the industry is that if banks are not taking in deposits, then they have a lending issue, right? And now if people are taking their money out, now you have, again, a liquidity issue. So for investors, this could pose a problem as far as what's available for the funding on looking to make the moves. Now, that's going to carry across a couple different streams, right? You have residential, commercial, different types of lending. you'll see a lot of people right now talking about some of the benefits of this, if you will, in the residential side of things, which for investors could still mean 2 to 4 units, right? So still investment properties and for investors, but because what this has done now is called the Federal Reserve, it's called light to the Federal Reserve's policy and how quickly they've hiked interest rates and saying, okay, well, everyone had their money here, now you put it up here and you created a problem, right? Which I'm just going to put it out there real quick. Like no one saw that, right? I saw that, and the people that are running the show, so to speak, in these different areas are much smarter than I am. So it's interesting to see how that's played out. But without going down that road, looking at this, what you see then is we're going to find that now the Feds are talking about pausing the interest rate hike, and then interest rates dropping, which has got a lot of people in the real estate industry. Well, they're happy. Whether they're excited or not, I don't know, right? But it puts you in a position where interest rates start to come down, and we start to see that spike some activity. On the investor side, though, there's still a lot of hesitation in the secondary market through Fannie Mae and Freddie Mac for investment loans. They've become very expensive, because there is that flight when you're dealing with the situation of what we came through the pandemic and through uncertainty. You uncertain times create this risk aversion, right? And banks look at this and say, if push comes to shove, or if it comes down to it, basically you're going to keep your house rather than your investment. So they make it more expensive. A lot of times banks don't like to say we don't do things. Instead, we just make it expensive so you don't want it, right? So I'll be curious to see how this plays out through Fannie Mae and Freddie Mac, because there is still that corresponds now with still a tremendous focus on affordable housing and how to try and create that, which is beneficial for the multi-unit space. And I can get further into that, but I know we got a short period of time.
Yeah, I mean, I think there are a couple things, right? So you talked about, first of all, one of the impacts that investors can see is the potential for interest rates to come back down, and seeing them flatten out. Maybe they're not going to do the rate hikes that were planned previously, and maybe you will see interest rates start to tamper off a little bit and come down, and that could be opportunity for real estate investors. On the flip side of that, Fannie Mae, Freddie Mac, they're still very hesitant in the lending space for investment properties are concerned, and they may want to continue to provide terms that are less than favorable to really shy away from encouraging investors to continue to be aggressive in the current market. One of the things that I know I was reading about was just understanding kind of where you are with your loan, the loan covenants, some of the details in it. I imagine many investors, or most investors, don't understand kind of the financial situation of their lender. We go to a bank, they're there, we see the building, you assume that you put your money in there, it's FDIC insured, you're going to be able to get your money back. And then this bank run really made people wonder how secure their capital actually was, particularly some of these smaller banks. As an investor, when you have a loan with, a lender, and not necessarily SVB, but especially these regional banks or these other lenders, are there specific things we should be paying attention to, questions we should ask, or any moves we may want to anticipate to protect ourselves in this current situation?
Well, I think the best way to protect yourself in any situation is education and having a better understanding of how that system works. For anyone with open, that have loans from these banks, they weren't really the ones taking it on the chin, right? Because that debt will stay there. You're still gonna. It's funny. Someone's like, oh, this bank crashed and I owe him money. Now I'm debt free. And it's like, no, there's when Two Fingers Tony goes down, there's a guy next to him coming up to buy that book of business, and that's the way it goes. But the people that obviously where you create that issue are the people who have stock in some of those banks that lost a lot of value. But I think that you want to, as an investor, you want to make sure that you're well aware of the terms. And I think that something that can catch people off guard is, depending on what type of lending you're dealing with, you might see balloon payments. There might be other types of parameters or set boundaries on the type of loan that you've taken out that you normally haven't thought about. Or let's just say this: you haven't thought about it for a while because it hasn't been a concern, and now that's something you have to watch out for. I have on the residential side with people in that space, I have clients who had adjustable rate mortgages on their homes because they were their primary residence. They converted them to their investment property, which is a great move. And at the time, their interest rates were so low, there was no one wanted to refinance out of it, right? But then set it, forget it, don't think about it. Rates go up, your rate adjusts to the maximum adjustment amount, and now all of a sudden your interest rate is much higher than it would have been. So being aware of what's the worst case scenario in anything, I call it hope for the best, but plan for the worst, and that's going to help protect you at least. But one thing we did see through all this, again, it's not those people who had their money in those deposits that were, with the government stepping in on this. Those people have been protected above that FDIC insured amount. So again, it's the stockholders that took hit on this. So, but again, to stay in line with the question, protect yourself through education, know your terms, and know and what is the worst thing that could happen, and just assume that could happen.
Thank you for that, man. I think understanding the terms, making sure you understand some of those, maybe due on sales clauses and things like that are in your agreement, that allows you to stay informed and kind of have those conversations preemptively to make sure you're doing everything you can to stay in control of your loan. Talk to us a little bit more about kind of where you are, right? Tell me about guaranteed rate. I know you guys work with a lot of investors, particularly in that 2 to 4 unit space, but tell me about guaranteed rate and some of the benefits that you all have when it comes to working with investors.
So I think one of the benefits that we have in a situation like this is that we do, work with a large amount of investors, right? Over 70 go to just out of the gate, 70 different investors that we can work with. So where that protects us is that when there's a liquidity concern, maybe some of the lines where you get your money from could dry up, right? But we have a very strong supply, let's just say. And outside of that, where we're able to place our loans in the secondary market, we have a very large portion of players out there that buy mortgages back from us when we need to stay liquid. So through all of this in that residential space, we're in a really good position. Guaranteed Rate as a company is very strong. I mean, we're debt free. We've done well. Victor Tardelli has built an amazing company, and amazing, he's a great leader, and he looks forward. And we've taken steps that protect us against these types of movement, because again, hope for the best, plan for the worst, right? You don't want to be in a position where you're not liquid and you can't lend. And this is not the first time that the mortgage industry has seen, well, let's just say had concerns, right? So we're doing really, really well. And of course, because we're in that residential space, I mean, you see the little smile on my face. I mean, it's not to smile against any of the hardship that anyone will endure through any of this. It's a smile because as we watch interest rates move and we see business move up, it keeps us keeps us busy. I mentioned earlier, just to give you a quick idea of what I was alluding to, and I said how that this type of situation is good for the multi-unit space. Well, it was back in the crash in 2006 to 2008 when we saw obviously big issues, that we were put into a position where there were loan products that came out of it that were focused on helping affordable housing. Well, we were able to benefit on that. This was primarily one loan, the Home Possible loan, which was allowed investors to put 5% down using conventional money and to receive much better terms, right? You've got fixed money at a cheap rate with a low investment with leveraging your cash. Well, at that time we came out of that and they removed, income restrictions. So you can have investors who are doing very well use these terms, whereas they're originally designed to help more people that are in a median income. That's changed in several years now that we've been in a position where they re-implemented those limits on your income. Now, I'm not saying that it's going to happen, but it wouldn't be unheard of that in the push to look at affordable housing. Just keep in mind, if someone buys a property and they're going to live in the unit and rent the other units out, that's good for the community. So in an effort to do that, maybe we'll see those loans start to come back. So I'm hopeful,
I love it, man. Well, listen, I think it's great to understand like where the company is. And again, this conversation on SVB Bank has made everybody think more about kind of their own lender and their current loan situation. You talked about being a debt-free company. That's really important to understand. Now we know that, hey, when it comes to some of the financial challenges that, many people are going through right now, this is not one of those things that will impact a company like Guaranteed Rate. So really great tips and insights for us to understand who our lender is, what are they looking for, and how can they help us achieve our own financial goals. Sam, we started by talking about the Midwest Summit. You all have been great partners of our event from the very beginning. Just to explain from your perspective, why do you guys get excited about the Midwest Summit, and why do you look forward to the partnership?
I'm I'm a geek for education, right? It's just a it's and and that's why I love the partnerships. John, you're an amazing individual at what you do. You strive for excellence. Your execution is on point. Bree Schmidt is by far one of the smartest people I know in this industry when it comes to this focus. And I love being involved with people who actually take the time to understand, educate themselves, and then continue that education to figure out how to adjust, because things are always changing, and you guys are spot on point. And what's great about this summit and what's coming, not to make this sound like a commercial, because I'm really not. I truly believe this. You're bringing that education to people. You're bringing this awareness. You're putting people in a room with otherwise, people that they're not able to sit down and have these types of conversations and understanding with, and that's tremendous. And I know obviously we've got to buy tickets. We're coming to the summit. I think it's a great value for what you're giving, but it's just amazing at how many resources we have out there now that are worth so much more. I mean, go back 30 years when people paid how much for college educations because that was your only choice. And now just look at what we have in front of us, and ways that are not only teaching us about history or different things like you learn in school, but actually teaching you how to make money, right? Because I went to college and I learned a lot, but they didn't teach me how to make money. So I don't know, man. Education. You hear me say it. You've heard me say it before. It's my thing.
Absolutely. Well, listen, we definitely look forward to catching up with you. We're excited about the event. And as you mentioned, me and my partner, Bree Schmidt, we're excited to bring this event on, and it's going to be a great time. Well, Sam, hey, I want to thank you for your time this morning, just talking a little bit about the SVB collapse and what that means for real estate investors. And my takeaways are this, one, make sure you understand what's happening with interest rates. Keep monitoring that. Interest rates are likely to come down, even if it's just for a short period of time. It may force the Fed to slow down on these rate hikes. So let's kind of keep monitoring that situation. But also, as an investor, you want to protect yourself. You want to make sure you understand the terms of your loans, anything that could cause your loan to come due. And even if your lender does, go under or have some issues, there's going to be somebody else that's going to pick up that loan. So make sure you're planning accordingly and not hoping that that's a get out of jail free card. So really important for you to be proactive in what your loan situation is and making sure you have the right partners to help you reach your financial goals. Sam, for people who want to learn more about you, where can they get in touch?
I mean, you can find me anywhere on social media. If you do a quick Google search for Sam Sharp, I'll usually come up right away. If you put mortgage in there, definitely. But you can find me on Instagram, Sam Sharp _ guaranteed rate, Facebook, different channels out there, and you may even find me on TikTok. So if you look out
You
there,
doing dances?
reach out. I've flirted with some entertaining
Sounds
antics.
like a yes. Okay.
I don't know if you call them dances, but let's just say that I love entertainment. We'll go for that.
I love it. Well, Sam, hey, look forward to seeing you again in a couple months, man. Actually, we're only about what 6-8 weeks out at this point, so it's coming up fast. So it's gonna be pretty fast here. But hey, Sam, look forward to seeing you soon. Thank you again for your time this morning, man. We'll talk to you again
Thanks,
soon. All right.
John. Always a pleasure, everyone. Thanks for listening. Take care.
So listen, Sam is just one of the partners we're going to have at this year's Midwest Real Estate Networking Summit. The event is going to be May 6th and 7th in Chicago, and we're really excited. You can get your tickets now at midwestresummit.com. Our pre-sale tickets are there for another day before they go up in price, and then we have until April 1st before they go to full regular price. So now is the time to get your ticket. In the meantime, we're going to keep having conversations like this with some of our partners and some of our speakers. So if you got some good value out of this, make sure you join our email list, sign up again at midwestresummit.com, and we hope you have a great day. Take care, everybody.